Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is cost volume profit analysis using activity-based costing. If you want a video about the basics of cost volume and profit analysis, we have it, and the link is in our video description. And by the way, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarping, there is a new video there every day. And like this video, of course. So, what is break-even point? A brief review here. The sales level at which operating income is zero, so total revenue equal total expenses. Sales below break-even point, we have a loss. Sales above break-even point, we have a profit. And our formula, without working with ABC, our traditional formula for break-even point, in units, fixed expenses plus operating income divided by contribution margin per unit, or the traditional break-even point where when we have no loss, our operating income is nothing. Okay, so this is the general formula. And if we want the sales in dollars or in any other currency, fixed expenses plus operating income divided by contribution margin ratio. However, with ABC, this formula doesn't work. To find your sales in dollar, you need the sales in unit times the selling price. It is the easiest one. Okay. And what is the difference between the traditional cost volume and profit analysis and with ABC? The conventional approach to CVP analysis is to use a volume-based measure to forecast cost. But an ABC approach is also possible. If the assumption is made that the total batch level costs are fixed relative to number of batches, both approach will produce the same result. So, okay, all of our costs, they are fixed. We cannot find any relationship between our costs and our batches. So they are 100% fixed, so they are the same. However, if the activity cost pool is a mixed cost, the ABC approach will provide a more accurate estimate of cost because the volume-based approach treats all activity costs that do not vary with output volume, such as machine setup, materials handling, special, and engineering as fixed. So, sometimes we have mixed costs, and the traditional way consider it a fixed cost. However, activity-based costs, they can vary based on activities, based on the number of batches. So we can create a new variable cost here, but not based on units of sales, but in batches. How do we do that? Go to our Excel file. They are free, and the link to download it is in our video description. So let's consider here that we have selling price 75, variable cost 35, desired profit 48. Or let's change it 70 and 28. It will be and desired profit 50. Changing numbers. And our fixed cost is 60. However, uh, so sorry. 50,000, they are pure fixed costs. They don't change by any means. However, we have 10 that they are fixed, but they vary based on batches. And this 10 is the remaining 50 less 60 less 50. And how can we find this variation here? Let's consider on this particular month, our production units is 3,000 units, and we produce in batches of 25. So on this particular month, we work with 120 batches. So if this $10,000 varies according to the number of batches, our variable cost per batch is 83. So we have now a new variable cost per batch. And then what is our new formula? Fixed cost plus operating income. That is exactly the same. Divided by contribution margin unit less, because we have a new variable cost here. This variable cost per batch divided by number of units per batch. So how do we do that? Let's delete it. Fixed cost, and now only the fixed cost plus operating income or desired profit divided by double parentheses here. Contribution margin per unit, 70 less 28, less variable cost per batch divided by number of units per batch. And 2,586. And now we don't have this contribution margin in percentage anymore because we can create it. We need to add these variable costs in our contribution margin ratio. However, it's much easier. Just do break-even point in units times the selling price. If we would consider the traditional cost volume profit analysis, what we would be doing? Break-even point. Fixed cost 60 plus desired profit 50 divided by contribution margin. So 2,000 and 2.6 thousand, 2,600 units. And in dollars, we don't have the contribution margin ratio here, so break-even point in units times selling price. When we consider activity-based costing, usually our break-even point will be lower because it is more accurate. We have $10,000 here that they are actually a variable cost based on number of batches, not based in number of units produced, but based in number of batches. So we allocate $10,000, so we move from fixed cost to variable cost. That creates a lower break-even point. The more variable cost we have, the lowest will be our contribution margin, so the lowest will be our break-even point. Okay, guys, so this is more accurate, and if your company works with activity-based costing, maybe this approach would be better. Okay, guys, thank you. Oh, and here we have the formula here if you want to. Okay, so guys, uh, thank you so much. If you have questions or comments, just leave it here or email me at jscarping@gmail.com. Have a nice day and God bless you.